Everyone thinks markets move logically until silver erases weeks of sanity in 48 hours. One day you feel smart, next day price action makes you question every decision possible. I watched silver drop 8% into New Year's Eve, smashing straight down near 70.5. Fear exploded everywhere, timelines screamed collapse, and confidence vanished faster than liquidity during holidays. Then January 2nd arrived, and silver reversed hard, trading near 73.83. In a single session, half the crash disappeared, leaving emotional traders completely disoriented and frustrated. Most people miss this part. Markets love hurting both buyers and sellers before real trends appear. If you sold into panic, you locked losses. If you chased rallies, you still felt trapped. That back and forth isn't random. In my opinion, it's designed to drain impatient capital. Professionals call this environment a grinder because leverage gets destroyed while calm capital survives. Price isn't trending yet. It's rotating violently between roughly 70 support and 75 resistance. Anything between those numbers is psychological warfare, not opportunity, especially for short-term traders. So why did silver collapse first, then rebound so aggressively within days afterward? The answer starts with forced selling, regulatory pressures, and year-end balance sheet games. Banks needed cash before calendars flipped, so risk assets like silver became convenient sources. Once January began, that selling pressure vanished, and natural buyers quietly stepped back in. Notice something important. Despite the bounce, silver remains inside the same tight battlefield. That middle zone is dangerous because algorithms exploit human emotions like fear and missing out. Retail buys strength, sells weakness, repeating the cycle that transfers money upward consistently. Volatility is basically a tax on impatience, paid by anyone glued to 5-minute charts. Gold tells a calmer story, trading around 4,363, up nearly 40. Gold held structure while silver swung wildly, signaling the broader inflation narrative remains intact. If gold had collapsed hundreds of dollars, I'd worry, but that simply didn't happen. This tells me silver's chaos is mostly about thin holiday liquidity, not broken fundamentals. Low-volume markets exaggerate moves, where small orders push prices multiple dollars instantly. That noise tricks traders into believing trends are forming when reality says consolidation. Many jumped on short squeeze narratives, then abandoned them, then returned again emotionally. Real squeezes don't behave like this. They move relentlessly without violent pullbacks. What we're seeing now is positioning, big players testing levels and exhausting weaker hands. Think of 70 as the line buyers defend, and 75 as the seller fortress. Inside that range, money gets burned, while patience is rewarded outside it. January buying has started, but conservative funds don't chase price during extreme volatility. They accumulate slowly, using limits, building floors rather than creating explosive rallies. That steady absorption is invisible, but it explains why sharp drops keep getting bought. Leverage is the real enemy here, not volatility itself, and this cannot be overstated. A futures trader buying near 80 gets wiped when price hits 70, regardless of rebounds. Cash holders survive swings easily because price levels don't force liquidation or panic. In my view, this market is intentionally hunting borrowed money to reset positioning. As long as 70 holds, the larger bull case remains intact and powerful. Break below 70, and yes, reassessment becomes necessary, but that hasn't happened. The drop to 70.5 served another purpose, generating liquidity for larger buyers. Big money can't enter quietly without triggering stops and forcing sellers into the market. Those stops clustered below 72, 71, and finally around 70. Once triggered, selling flooded in, allowing institutions to absorb supply efficiently. After orders filled, artificial pressure vanished, explaining the rapid snapback higher. This process feels unfair, but it's how modern markets actually function. What fascinates me is the physical market refusing to confirm paper volatility. When spot hit 70.5, dealers didn't slash prices, they raised premiums instead. That tells you everything about real-world confidence and perceived scarcity. Physical silver traded closer to 90, revealing a widening disconnect worth watching closely. Paper prices swing wildly, but physical holders remain steady, which is incredibly revealing. Mining stocks struggle in this environment because valuation becomes difficult amid extreme uncertainty. Yet step back, even $70 silver represents massive profitability for most producers. Last year's worst case was 25 silver. Today's worst case is 70. That shift alone explains why miners are deeply mispriced right now. Once volatility settles, value investors will notice margins and reprice accordingly. Technically, recent candles show compression, signaling energy building rather than trend failure. Inside bars often precede explosive moves once price chooses direction decisively. Monday matters because real volume returns when professionals leave vacation mode. Holiday weeks are playgrounds for algorithms, not reflections of true demand. Weekend risk remains because geopolitics don't pause while markets close. Any major headline could gap silver significantly when futures reopen Sunday night. Gold remains the compass, and as long as it holds above 4,300, silver's long-term path stays upward, especially with gold to silver ratio near 59. Historically, bull markets push that ratio toward 30, implying silver outperformance ahead. Institutional money arriving next week is sticky, not speculative, and removes available supply. That's how real trends start, quietly, after exhausting everyone emotionally. Meanwhile, global tensions and strategic demand only strengthen silver's role as insurance. China continues absorbing metal, draining inventories, shortening the lifespan of paper games. The biggest challenge now isn't charts, it's psychology and resisting premature exits. Wealthy investors think in years, not days, exploiting time instead of price fluctuations. They buy from impatient sellers today, planning to sell to desperate buyers tomorrow. Targets matter, but ratios matter more. Swapping silver for gold beats selling for cash. At 60-1, silver remains historically cheap, meaning the journey isn't finished. Selling early is the real risk, not volatility, especially entering the mania phase. This brutal week wasn't failure. It was preparation, clearing the runway for continuation. Silver survived manipulation, reclaimed 73, and enters the year structurally stronger. If this breakdown helped you think clearer, subscribe to the channel for deeper market insights.